Hello and welcome to Market Domination. I'm Julie Hyman. That's Josh Lipton, live from our New York City headquarters. We are giving you the ultimate investing playbook to help tune out the noise and make the right moves for your money.
And here's your headline blitz, getting you up to speed 1 hour before the closing bell rings on Wall Street.
The first thing is to hopefully assure the market that everything is going smoothly, everything is on the right track. I'm not sure that Intel's communication so far on this has been as clear as it could have been, but at the very least, you have two interim CEOs right now that are very competent. I think that the very first step, though, is going to be to find the next CEO, the next leader of Intel, and put it on the right path to recovery and growth.
What we've got is a backdrop of very strong economic growth. We have a Federal Reserve where, yes, there's question marks about how much they're going to cut, but they do have an easing bias, not a tightening bias. And then although we have some of the policy uncertainty ahead of us, generally speaking, a lot of the proposals really reinforce that narrative of US exceptionalism. So as we're looking out around the global space, how markets going to do around the world, the one thing that continues to stick out to us is really our US outperformance persisting through into 2025.
You know, the environment has been set up very well. We were on a rate reduction cycle. We now have a Republican administration coming into power. They've been very clear about what they want to do. They want to incentivize business to expand. They want to bring jobs back to the U.S. We'll see how that goes. But overall, it's very positive from the business standpoint.
We've got 1 hour to go until the market close, so let's take a look at the major averages here. We see a mixed picture. The Dow off by about 77 points, almost 0.2%. The S&P 500, though, is at another record. Again, I think we're 54, perhaps, is where we are at this point, up about 0.25%. The Nasdaq, though, is joining the party for the first time in a while, hitting an intraday record, and it looks like it's going to close at that level, too.
Yeah, and some big events this week, Julie. So Wednesday, you're going to hear Fed Chief Jay Powell speak. So as usual, everybody will be hanging on every word. What does he have to say about the economy, the jobs market, inflation? And then speaking of the jobs market, that big jobs report on Friday. Question for investors is, is that data kind of come in Goldilocks, not too hot, not too cold, sort of reaffirming what a lot of investors have been betting on, which is soft landing, dovish Fed.
Right. I'm sure all of that, though, is going to reignite the debate over whether the Fed is indeed going to cut at its December meeting. If we look at what is on the move today, we've got, as I said, the Nasdaq outperformance. You can see that in the performance of the Magnificent Seven today. Everything is trading higher, a little bit more mixed elsewhere, but sort of largest of large cap tech is leading. Where that's even more notable is if you look at the sectors here today, most everything is down except for tech, communication services, and consumer discretionary. So, we keep talking about broadening. Today, that's not really happening. It's more that tech that's pulling everything higher.
I think our next guest actually might be neutral on tech, if memory serves. Let's see.
I think that's right.
With stocks closing at a strong November here, should investors expect another month of gains? For more, let's welcome in Ryan Dietrich, Carson Group Chief Market Strategist. Always good to see you, my friend, have you on the show. How about a history lesson to start here, Ryan? What does December teach us historically about the market? What do traders and investors need to know?
Yeah, thanks for having me back, first off. I mean, listen, I know I joined you guys probably about a month ago. We talked about why November is usually pretty strong. Well, that played out with the best month of the year. Then you talk about December. No month, on average, is up more likely than the month of December. It's up like 74% of the time. In an election year, no month is up more likely, up about 83 or 84% of the time. Here's what's really interesting. If you go back the last 10 elections, so about 40 years, December's been higher for the S&P 9 out of the last 10 times. When you're up 20% for the year going into the last month of the year, like we were this time. And again, this was actually, I believe it called your chart of the day in your briefing note this morning email. So thank you for adding me there. When you're up 20%, the last 10 times, December's been higher, 9 of them. All right, so I just threw a lot of numbers out. I get it. The reality is we've been bullish. We think there's still a little bit more to go, and December is probably going to be a pretty solid month, guys.
Now is where I insert that time-honored disclaimer. Past performance is no guarantee of future results. Yep. But I am curious, when people have a year like this, what kind of end-of-year positioning do we tend to see? because people don't want to, if you've even matched the market's gains this year, let alone outperformed, you don't want to do anything to mess that up in December, right? So how does that kind of play out as the month goes on?
Well, great question there. Right before the election, let's kind of combine these 2 months, really. I mean, what did we see, right? We saw a lot of puts coming in. We saw a lot of hedging. We saw the VIX higher. And we said, listen, when the election's over, the uncertainty's alleviated. It doesn't really matter who wins. We expected to see an upward bias. And that's what happened. And I'll tell you, I do this for a living, right? Talk to a lot of people. The honest truth, a lot of big institutional money managers have missed a lot of this rally. They've been even weight. They've been underweight, overweight bonds. And it's cliche to say, I get it, cash on the sidelines, but it's one thing we've expected. And again, at the end of the year, that's why I think you tend to see this upward bias. There's not a lot of news normally in December. Now this one, hey, we do have a Fed meeting. Will they or won't they cut? We've got a couple things to think about, but the reality is you tend to see a chase in strong years. And we just think that's the case. And still, with a lot of money managers underperforming overall, that's why we think it'll still happen.
And Ryan, listen, you've been overweight equities, I think, since December 2022. You remain overweight here. So beyond December, though, looking further out in 2025, why remain constructive, Ryan? What are the reasons?
Yeah, great question there. So 2 years ago right now, Carson Group went overweight equities. If you think back to that time, it wasn't very popular. People were not happy for whatever reason. Weren't happy with that call. We didn't think there'd be a recession. Thought stocks would do well. Now we're up over 60 some odd percent, over the last 2 years. What's going to happen next year? Well, we still think we have a dovish Fed, right? We still are looking at record earnings. We're still looking at the strongest profit margins this cycle. Yes, the third year of a new bull market tends to be a little bit choppier. So that's one thing that kind of can restrain us a little bit here. But I love that right before I came on, you guys talked about market breadth. And I know I've come on for a while saying expect more participation. That's what we've been seeing. 2 weeks ago, 10 out of 11 groups outperformed the S&P. Last week, 8 out of 11 groups outperformed the S&P 500. We've got small cap leadership. We've got mid cap leadership. We think next year a big theme again is that overall a lot of participation. We've been neutral tech all year. People didn't like that earlier in the year, but now it's not like we hate tech. Neutral, people hear neutral. Oh, that means they're bearish. No, we've got a lot of tech exposure in the money we run. We just aren't going overweight because again, there are some valuation issues. There are potentially a lot of high bar when it comes to technology. So we just think some of these other areas look really, really good, specifically small and mid and those cyclical areas, which have been leading, really the second half of this year.
And Ryan, that's a really good reminder for people, by the way. When you say neutral, it means you hold it the same way to the market. You're not necessarily buying, not necessarily selling to get that all out of whack. What could go wrong with all of this? What's the biggest risk right now?
Yeah, I'll tell you, I guess I'll go two. Valuations are stretched. Now, honestly, 12 months ago, people were talking about valuation stretch. That just means the bar is a little higher. But the one that gets me more than anything, the strength in the U.S. dollar. Normally when the dollar's strong, to have a risk-off scenario. We've got a strong dollar since the election. Now, I'll tell you what, I think a lot of people are talking about this stronger dollar. A lot of people are talking about higher yields. That inner contrarian in me thinks those are going to come back down. But if the U.S. dollar continues to strengthen, that could kind of upset the apple cart. And look at what happened just the last 2 weeks, right? International markets haven't done very well because dollar's been strong. U.S. markets done just fine. I'm honestly surprised how strong U.S. markets have done with the dollar strength we've seen. But the dollar continues to be pretty strong here. That could be one thing here that can upset the apple cart, as they say.
And Ryan, how are you thinking about the incoming Trump administration as a strategist? Taxes, deregulation, tariffs. I'm guessing you're getting questions about it.
Yeah, we get those questions. Honest to goodness, we don't put a ton of emphasis on it. Now, I'll be aware we've liked small caps. We've liked mid caps. Yes, you've got lower taxes. You've got an economy that's strengthening. Look at just today's data. It doesn't do with President Trump coming in. Stronger construction. Manufacturing is likely bottoming. I mean, the underlying economy continues to be strong here. And I'm a creature of habit. I look at what happened, when Trump was in office last time. The market did okay last I checked. Obviously, the market's done just fine under President Biden as well. So the bottom line is don't get too worked up over these things is what we say. Everyone said before with President Trump, a lot of people talk about this, which groups would do well. The exact opposite happened. So don't just think it's always so obvious. But the reality, again, is he's put some people in play. I know some of the more extreme people he's put out there. I don't want to go that way. But look at the Treasury Secretary, right? I mean, that's kind of right down the middle. People like that. I think he understands his scorecard is the market. I mean, that's one thing we know about President Trump. His scorecard is the stock market, and he's picking some, we think some pretty good people that can be on that side of the keeping the market and the bull market honestly afloat.
And as you say, he has an interest in keeping it up there since he does see it as a referendum on his performance. Thanks a lot, Ryan. Great to see you as always.
Thank you, guys. Appreciate it.
We're just getting started here on Market Domination. Coming up, Pat Gelsinger is out as CEO of Intel. He's stepping down from his position effective immediately. So what's next for the chipmaker? Plus, the potential impact on the food sector under RFK Jr. and why packaged food companies maybe should be concerned, or at least they should be paying attention. Plus, the savings fund doesn't end with Cyber Monday. Travel Tuesday offers shoppers another day dedicated to deals, but how can you benefit your financial portfolio? Stick around. Much more Market Domination still to come.
Are you ready to master the markets and, dare I say, become a better leader in the process? Well, Yahoo Finance has you covered with our new full suite of original podcast content. Whether you're a seasoned investor or you're just starting your financial journey, we offer invaluable market insights and strategies to help boost your portfolio, build your wealth, and make you a successful investor. Now let's make some money and get a lot smarter.
I've done Yahoo Finance forever. This is a spectacular spot.
Welcome to Stocks in Translation. I'm your host, Jared Blickery.
Hello, world. I'm Ross Mack.
Hi, I'm Bob Powell, and welcome to Decoding Retirement.
Welcome to Living Not So Fabulously.
Hey, it's me, Tiffany the Budgetista, your favorite financial educator. Welcome to Capital Gains. We're on for a few days and everything has changed.
From Wall Street to Main Street to the C-suite, we are your daily lifeline, because behind every great investor is Yahoo Finance. Join us on yahoofinance.com, the Yahoo Finance app, or wherever you get your podcasts.
Intel CEO Pat Gelsinger is stepping down today after a career spanning more than 40 years. but he did have a rocky tenure, I should say rocky second tenure really, at the helm of the chip giant over the past few years. In a post on X, Gelsinger wrote, "Leading Intel has been the honor of my lifetime. I'm forever grateful for the many colleagues around the world who I've worked with as part of the Intel family and can look back with pride at all that we have accomplished together. Thank you all." Intel said it would begin a search for a new CEO immediately, with CFO David Zinsner and CEO of Intel Products Michelle Johnston Holthouse named as interim co-CEOs. Joining us now, Christopher Danley, Citi Head of U.S. Semiconductor Research, to talk more about all of this. Chris, I'd love your take on especially whether you think Gelsinger should, it sounds like, according to some reports, he was asked to step aside or forced out. Do you think this was the right move for Intel? You've written in some recent notes that it wasn't necessarily.
Yeah, when they hired Pat, I think it was 3 years ago or 3.5 years ago, and by the way, thanks for having me on. When they hired him, we thought, and we still think, that he was the best person for the job because, Intel had a series of misexecutions, right? And they really needed to get their manufacturing on track. And we all know Intel is a leading, not bleeding edge semiconductor company. And so to run Intel, you need somebody with some technical chops, manufacturing chops, and then also you need somebody that knows Intel, right? It's got a very strong corporate culture. It's been around for a long, long time. We thought Pat was the best guy for the job. And then, I think that a lot of folks don't understand or recognize, how complicated it is to run a company like that and what you need to do from a hiring perspective, right? So it took him a year just to hire and fire the right people. And I would say that he was flawless in terms of who he got rid of and then who he brought on. And now that he's gone, I think that he's done a lot to get their manufacturing back up to the level of the competitor, which essentially is Taiwan Semi. And as it stands right now, if they continue to hit their marks, about a year from now, they will draw even. The problem is this insistence on the foundry business. We don't think that, put it this way, we think there's a very, very slim chance that it's ever going to work for Intel. Most of the people we talk to in the semi industry know that, realize that. Intel's been at it for a long, long time. And so we think that they should get out of foundry. And I think that part of the reason Pat's gone is his insistence on trying to make foundry work. They're still losing billions of dollars every quarter. So it's a real shame. I think internally on their manufacturing for CPUs, he did very, very well, and they're on track. It's just foundry has been an absolute millstone around the company's neck, and I think that's ultimately what got him shoved out the door, unfortunately.
And Chris, though, in terms of what happens next with those fabs, here's what Bernstein, Stacy Rasgon, here's what he told his clients, Chris. He says, while keeping them feels like dead weight, scrapping them would also be fraught with difficulties around the product roadmap, outsourcing strategy, CHIPS Act, and political navigation. What do you make of that, Chris?
Yeah, so I think what Stacy's talking about is their internal manufacturing. And I still think they should manufacture their own CPUs. I know there's some speculation. There's been speculation for a long time that they're just going to turn the keys over to Taiwan Semi and have Taiwan Semi make everything, i.e. their CPUs. We don't think that that's the right move. Obviously, there's geopolitical considerations there. But B, Intel can do just fine making their own chips. The problem that they ran into was trying to make other people's chips, whether it's Apple or NVIDIA or Qualcomm. It's a completely different ballgame, and it's not what the company's forte is. So I think Stacy's talking about like abandoning everything, including internal manufacturing, and really we think they should get out of the merchant foundry business, making chips for other semiconductor companies.
And so, Chris, the agreements that Intel has entered into, the plants that it's in the process or is planning to build here in the United States, what is the plans for that capacity? In other words, can that capacity just be devoted to making Intel? Is there enough demand from Intel chips themselves? Or are they going to need, if they do indeed abandon the merchant foundry, are they going to need to scale back those plans?
Yeah, you'd have to scale back. You'd have to lay off people. I mean, really, they just started breaking dirt on, I believe, the Ohio fabrication facility. So I'm sure there would be some sunk cost, but the alternative is you keep losing billions of dollars a quarter. That's I'm no math whiz, but that's not good. So I think you just need to scrap it, get out of it, take your lumps. If you have to, return the money to the government, because it's just going to be lit on fire, and say, hey, let's go back to doing what we do best.
And Chris, with this announcement, Intel did name interim co-CEOs. I'm curious what you make of them, Chris, and then also who you think is going to get the permanent job here. If not a name, what's the background you want to see? I mean, I remember when Gelsinger got the job, a lot of folks were excited because they looked at Gelsinger and they thought, hey, that's a technologist, that's an engineer's engineer.
Yeah, he was a perfect guy for the job. In reality, I wish Intel would have gotten rid of Merchant Foundry, and kept Pat. I think he was the best guy for the job. So you need to find somebody out there that knows technology, like leading edge semiconductor technology, knows manufacturing, and then also knows Intel, right? Because it's got a very strong corporate culture. I am a big fan of both Dave and Michelle. I've known them both for a long, long time. We're talking, 15 years or something like that. And I think as long as they are intimately involved in the choice for a new CEO, I have confidence that they will find the best person available. Problem is you need those three requirements there, and those people don't grow on trees, right? Especially with that bleeding edge knowledge of Intel. So they have their work cut out for them. I don't expect to see anybody named anytime soon. In fact, when they were looking at Pat 3 years ago, we threw out a bunch of different names, and we said, man, Pat is really the only obvious choice for the job. I think it's still like that. I'm honestly curious to see who they come up with.
Would there be a scenario where this co-CEO arrangement could persist and end up being the permanent position for them?
I don't think so. So Dave is great at finance. Michelle's great at sales and marketing. Neither of them really have the technology or manufacturing background that I believe, and I think they realize is needed. I think that's why they're interim CEOs. So I think they're going to go, I'm sure they'll look outside. They're going to look internally, and I wouldn't expect a decision to be made anytime soon.
All right, Chris, thanks very much for your perspective. Appreciate it.
Anytime.
Now, time for some of today's top trending tickers. You can scan the QR code below to check out the best, worst, and most traffic stocks of the session on Yahoo Finance's trending tickers page. Starting with Supermicro Computer, those shares are surging today. The server maker saying that an independent review of its accounting practices found no evidence of fraud or misconduct. At the same time, the committee that was reviewing the financials at Supermicro recommended that they find replacements for 3 positions: the chief financial officer, as well as the chief compliance officer and general counsel. And the CFO, Dave Wiegand, is going to be stepping down once they find his replacement.
Yeah, and also Kenneth Chung, formerly VP of Finance, are saying now be its chief accounting officer. Started the process, they say, to look for a new CFO. Also, company saying it doesn't expect changes to previously issued financial results for the most recent fiscal year, but a wild ride for this name this year. I mean, an AI darling at one point, and then the headlines started hitting, right? Missed the deadline to file its annual report, facing a DOJ probe, short sellers that we discussed.
Yeah.
Look at that chart.
Well, and there's a bit of a squeeze going on today, speaking of that last item in the short sellers. It's interesting here because at least a couple of analysts say, you know what, we're not getting back in here yet. JP Morgan and Rosenblatt Securities among those who said, even given what's going on, there's just too much uncertainty still for them to get back in the name. But somebody's getting back in today, even if they are not.
All right, turning to MicroStrategy, that company loading up on, you guessed it, more Bitcoin. So this one, remember about a month ago, they announced plans to raise $21 billion through stock sales to help fund more purchase of Bitcoin. Per Bloomberg, company now already about halfway to that goal. Sold 3.7 million shares over the past week. Used the proceeds to buy another 1.5 billion worth of Bitcoin. That is the 4th consecutive weekly purchase announced by the company.
Yes, and interesting here, we're now showing that biggest Bitcoin holders because Bloomberg Intelligence out with a note today that's saying the surge that we've seen in inflows to Bitcoin ETFs might mean that eventually they collectively hold more than Satoshi Nakamoto, who was the creator of Bitcoin, or the the alias of the person who created Bitcoin in any case, which I thought was interesting. MicroStrategy shares themselves are falling today, right? But we are still seeing plenty of interest in the bigger cryptoverse, including in those ETFs. There's been a lot of talk about MicroStrategy itself and the premium at which it trades to its Bitcoin holdings. So that's something. Here's how the Bitcoin ETFs are trading today as well. There are also, by the way, ETFs that track MicroStrategy specifically and that are levered plays on MicroStrategy, which is itself a levered play on Bitcoin. So, and there's been some concern about those recently because they don't always do what they're supposed to do. In other words, if they're supposed to be 2 times MicroStrategy, they're not always trading in that
Yeah,
fashion.
I did see reports that U.S. ETFs that invest directly in Bitcoin, in Ether, you're still seeing just incredible demand. I mean, just record monthly net inflows. Interest in Ether, I think, is also interesting, just speaking to this kind of growing and wider interest in the space.
And it's been catching, it had been lagging. And then in the most recent push, it has been catching up to some extent.
Maybe Bitcoin just dragging everything along with it to some
Yeah,
extent.
I mean, to some extent. Although, you know, the token that's most like Ethereum is Solana, and that's seen an upsurge in interest too. Then you get sort of spikes in interest in Doge, some of which is, you know, it's sort of a more memey one. So that gets, you know, bid up at different times too. So it's sort of, yes, it drags everything along, but it's not all in an even line, I guess is what I'm saying. And then finally, let's talk about PG&E, the power and natural gas company, announcing stock offerings. Remember, this is the big California-based utility. The shares are down because the company is offering shares and preferred stock, convertible shares as well. It did raise its dividend to 3 cents from 2 cents. But PG&E, if you recall, entered bankruptcy for at least the second time back in 2019 following wildfires in California. Remember, it was held liable for some of them and then came back to the market in 2020, and the shares have about doubled since then.
It looks like proceeds, they're saying, to be used for general corporate purposes, highlighting it might include, among other things, funding PG&E's 5-year capital investment plan. They did also affirm their 2024 adjusted earnings guidance. Stock, though, under some pressure today.
Yeah, the shares were trading near their highest since they came out of that bankruptcy. So something to keep in mind as well.
Coming up, we are speaking to a Tesla bull who is raising his price target on the EV maker to the highest on the street. Stick around, much more market domination still to come. Wall Street getting even more bullish on Tesla today, including Stifel raising its price target on that stock from $287 to $411. Now the highest on the street. And joining us now is the analyst behind that call, Stephen Gengaro, next-gen transport analyst at Stifel. Steve, it is good to see you. So you tell your clients, Steve, this one, it's still a buy. You do raise your target, so 411. That is up from 287. That's a nice size jump, Steve. How come? Walk us through it.
Thanks for having me. First, when we look at Tesla, I think one of the keys to remember is this is way more than an auto company. And when we start thinking about valuation, we worked hard to build in the full self-driving initiative and the cybercab initiative over time. And the biggest drivers of the price target change come from those two factors. We actually slightly lowered our auto margins because of concerns about the $7,500 tax credit, but the upside potential over the next several years coming from those two initiatives is quite honestly very large.
Well, I think the over time and several years is what I'm going to zoom in on here, Steve, because it doesn't feel like we have a huge amount of visibility around the exact timing, both because the company's given us some clues, but their timing, they don't have a great track record when it comes to doing things on time. So how are you thinking about that?
Yeah, are you saying Mr. Musk can be a little optimistic at times?
I would never.
So when we look at it, and we've written this, we've said this multiple times, you have to believe in the medium to long-term vision to buy the stock. If you look at this, in the very short term, and obviously there's bears out there who think the stock's way overvalued. They're looking at what's the auto business worth in the near term and the obstacles behind these initiatives. And one of the comfort levels that increased for us was really around Elon Musk's involvement with the Trump administration and this expectation that the path towards unsupervised full self-driving becomes a bit smoother. Now, is it going to happen over the next quarter or two? Probably not. I think the stock's going to trade off data points around progress on cybercab and full self-driving in the near term. But when we look at the long-term value in the name, and we're discounting, pretty heavily back the expectations for those two businesses, and then we're basically looking at the midpoint of potential value, and we're taking 50% of that midpoint. So yes, we're clearly more optimistic and more confident than we were. But we're not baking in kind of the full upside of these two initiatives.
I'm curious, Steve, you talk about sort of medium to longer term. In terms of more near term, let's call it the next 12 months, was part of your thesis here too also you're looking at the EV market, and are you just simply expecting Musk to kind of consolidate share there?
Yeah, it's interesting because, and going into the election, we wrote a few pieces about this, both from an energy and an EV perspective, where one of the risks to Donald Trump getting reelected was the removal of these tax credits, right? At a high level, people think, wow, that's bad for EVs. Well, it probably is. It probably does make them, it doesn't give you the kind of, obviously, the tax credit that lowers the price. But what it does do is the person who has, the company that's got the largest cost advantage, being Tesla, the company that has the most market share, being Tesla, they continue to lead. And arguably, they probably can expand or at least maintain that market share lead for longer, which actually bodes well for Tesla relative to the peers. But that is a near-term headwind. The EV adoption rates have, the growth rates have slowed, right? EV adoption hasn't gone down, but the growth rates have clearly slowed near term.
Steve, I think that the discussion around Musk's political fortunes has been really interesting. It has mostly been talked about as a positive, but I wonder how you think about the potential risks as well should the honeymoon not last, so to speak, between he and Donald Trump. Is that something that investors should at least keep in the back of their minds?
Yeah, I think there's two angles there, right? One is Stifel has a group called the Think Tank Group, and they do a lot of data analysis, which we share. And when you look at the willingness to buy an EV by those folks that don't own them between Republicans and Democrats, Republicans are much less likely to buy an EV if they don't already own one than Democrats. So the first step is maybe Elon Musk's support for Donald Trump and some of the initiatives actually swings that a little bit. That's one aspect, including there could be some pushback from the far left as well. But the other side, which you bring up, is fair. Like if the relationship breaks down over time, or if there are some things that maybe CEO Elon Musk doesn't get done because of Trump's pushback, there is that risk. And I think one of the risks, at a high level to the Tesla story is Elon Musk is obviously a somewhat controversial figure to people, and he's a huge element of the story. So it is one of the pieces of buying a Tesla stock that's always hard to weigh.
And finally, Steve, I have to ask you for a stock that had surged about 40% in just the past month, Steve. I got to ask you about valuation, which listen, you're bulled up, so you obviously still think it's attractive at these levels.
Yeah, and listen, if you look at valuation just at a snapshot, you're going to look at stock and say it's too expensive, right? So I think that's a fair pushback that we get from the bears. We do think you're going to see volatility in the stock in the short term. I think that's reasonable and expected. But I also think that when you look at the value creation that is likely over the next few years, we would be buying the stock for medium to long-term holders.
Steve, great to have you on the show today. Appreciate it.
No, thank you. Appreciate it.
All right, let's get to some calls of the day now. Bernstein raising its price target on Block. From 90, they go all the way up to 120. The lift from Bernstein does make that price target the highest on the street. Block, by the way, hitting a 52-week high in today's trade. Team at Bernstein maintains the outperform, does go with a target to 120, says the digital payments firm is our best new idea.
And by the way, that price target raise today sent the stock above their prior price target of $90. It is a 52-week high, but it's not a record high. It was way higher than this back in 20 and 21, interestingly enough here. But the analysts there are saying the plateauing of key metrics around Cash App has understandably contributed towards investors' lack of conviction. But they said, that they think Cash App and the company are going to end up doing well here.
Yeah, Cat said they say EBITDA growth 30%. Separately, by Goldman raised its target to 102, maintained a buy as well.
And also, let's talk about some cruise line operators, because Truist has raised its price target on multiple cruise lines. The note highlighting demand and a strong acceleration in pricing here. And I thought it was kind of funny here because the analyst over at Truist, led by Patrick Scholes, said, we tried to find something negative to make a contrarian call, and we couldn't do it. Things just look good here, that the demand is continuing here, and the pricing is also holding up well for these companies. He said, they might come out with some sort of conservative outlooks for 2025, but they've done that, and then they've surpassed those outlooks in the past.
Yeah, told his clients pricing for 2025 bookings have accelerated from prior checks, suggests significant upside to current consensus expectations. And then here was the key line, I think. He says, we observed 2025 cumulative industry-wide pricing currently tracking up high single digits year over year, which is materially higher, the analyst saying, than consensus expectations for 2025 ticket pricing growth. Of what he says is around 3.5% to 5% year over year. Bottom line, lifts his targets on a range of names. Royal Caribbean goes to 272, Viking to 49, Norwegian to 35, Carnival to 29, which ties a street high, by the way.
Yeah, and most of those are trading higher today. Yep. Well, let's turn to packaged food companies. They're under a lot of pressure with President-elect Donald Trump's pick of RFK Jr. to lead the Health and Human Services Department. Should he be confirmed by the Senate, RFK could start cracking down on things like processed foods and artificial additives. He could push for major changes to the Food and Drug Administration. For more on the potential impact on the food sector, we're bringing in John Baumgartner, Managing Director and Senior Consumer Equity Research Analyst at Mizuho. It's good to see you, John. So we've been having a lot of these conversations about the potential effects of the incoming administration. Understanding that it's all sort of hypothetical, we don't know, but I guess let's just start with RFK Jr. Do you think that he is, normally you're not a political analyst, but you kind of have to think about the odds of whether he is indeed going to be confirmed, first of all, to actually have that post. What do you think?
Well, I think just bracing for the worst. If he is confirmed, how does the industry respond, and what could he do? What tools are at his disposal? And I think big picture from the macro, our view is we don't think the industry is going to see anything it hasn't seen before. From a regulatory perspective, from a food science perspective, we've seen a number of issues over the years with ingredients regulations. And our view would be the tools available to an RFK would be between a stick and a carrot approach. And the stick approach across a range of drivers would be, one, in terms of what's most disruptive, would be a tightening of EBT food stamp allocations, reducing the limits, the categories you can buy on those products. Overall, food stamp spending is about 15% of total grocery spending overall. For some categories, such as soft drinks, frozen pizza, you're north of 20% for some of these categories. So short-term impact, most disruptive, be tightening up the EBT allocations. Second most impactful would be sugar taxes. We've seen sugar taxes in Mexico anywhere from a mid to high single-digit % increases going back to 2018. What do we see in the first 6 months after sugar tax? Volumes down mid-single digit.
So that effectively increases the total cost of items higher in sugar.
Correct. So you would see an elasticity impact on volume there. We've seen sugar taxes in the UK for 15, 20 years now, and that drove a reformulation of products going forward. So you saw sugar consumption come down, volumes went up over time. I think the third stick approach could be outright bans on certain ingredients. So think artificial flavors, artificial colors. We're less concerned about that in the short run because we think you're going to need a 3 or a 4 year period to give companies the chance to reformulate. I think a great example would be artificial trans fats. Those were banned by the FDA back in 2015. It was until 2018 you had to have them out of your products. California last summer instituted a ban on some artificial colors. That won't take effect until 2027. So we think that'll be more of a longer term adjustment. Now don't forget, most of these companies, multinationals, they operate in countries in Europe that have tighter regulations on ingredients. They've made these changes overseas anyway to begin with. So we think there's opportunities.
Let me ask you, John. So you point out, and you make a good point, there's so many question marks whether he gets confirmed. And we've had analysts on the show who worked at HHS who thought he might have a tough time. But then even if he does get confirmed, what his priorities will be, because RFK talks about a lot of things. But when you added it up like that and you saw, okay, here are the risks, were there certain names in your coverage universe that you thought were more at risk than others if he did get confirmed?
I think in our view, the names most at risk would be US-centric companies that over-index to these categories. So think Hershey, 85% of the portfolio in sugary snacks, 85% of sales in the US. I think those would be the most obvious ones that would be at risk. You're already fighting an uphill battle against elasticity with price increases over the past 2 or 3 years, higher cocoa costs coming through. I think uncertainty around consumer demand, which would be the next leg lower for that stock. So Hershey's the number one. I think in that vein, look at Mondelez, similar situation, sugary snacks. The US is about 30% of sales. So there you have an opportunity for a dislocation in the stock down 10% since election day. We think that's a buying opportunity in a name that's in the sugary space.
John, maybe you can help explain something to me. As you mentioned, and this is one of the things, by the way, that RFK Jr. and some other health food advocates have seized on, the fact that Europe has different regulations than we do and there are things that they don't allow. Why don't the food companies just make the food the same way everywhere? Why don't they get in front of it and just get rid of the stuff that Europe already bans, since there is something of a consumer movement against some of this stuff?
I think a big part of it is just local culture, local practice is what's easiest. I mean, if you look at this, it's easy to forget that in this industry, you've seen a 20-year push towards natural and organic products, with a big consumer push over the past decade, 20 years being, I don't want artificial ingredients, I don't want hormones in my products. And that drove this industry. And you've seen a range of improvements over the years, from reduced sodium in soup to elimination of trans fats, already a big move towards elimination of artificials. But from a food science perspective, you look at some of these products, it's a very complicated nature where you're gonna have certain colorings in certain products. I mean, look at General Mills, 2015, they removed artificial colors from Trix. Trix consumers were unhappy. They wanted the vibrant colors back again. And Mills had to go back and reformulate with the artificials again. So I think part of it's consumer demand, what sells locally for the culture. The other part is the food science, what helps with longer shelf life. Once you change certain ingredients, it throws off pH balances, you have to change something else. So it's just not so simple to reformulate in some cases. But if you're gonna be given a multi-year time horizon, if the culture is changing, the regulations are changing, that's where you'd have a response from the industry, in our view.
Do you think, John, so you named some companies that could, in theory, be at risk, right? Are there names that actually maybe could benefit, could be a tailwind, in the sense that, let's say he gets confirmed and he really promotes this sort of healthy eating, healthy living agenda, and that raises awareness and consumption of, hey, more people decide I want to eat fresh, organic, natural. Are there companies that you cover that you think, okay, those would actually be tailwinds for these names?
Unfortunately, in the packaged food space, there's all exposure, for the most part across the board. So I think what you're looking for are the publicly traded names or ones that have the limited exposure to the U.S. or to these categories. I think even in the healthy living space and protein nutrition, Bellring Brands, Simply Good Foods, companies that have low sugar, low carbs, high protein, labels. It's a $20 billion category growing high single digits. It's a nice time with the GLP-1 effects as well. So there's certain pockets in the industry where you will see outperformance in our view.
Oh, it's funny. That's the first time you mentioned GLP in this conversation, but that's sort of the other big theme and trend that has been cited as a potential risk for many of these companies.
He's made it clear he is not a fan.
Right, of those drugs. Right. But, so I don't know how you weigh this stuff as an analyst and figure out, do you see some of these threats as sort of existential for the industry? Or, as you say, is it just sort of stuff they've dealt with before that they're still dealing with?
I think separating the short term from the long term, and these stocks tend to move first before the numbers really change. And I think for this industry, you had the GLP-1s hit the end of last summer. That sort of whipsawed valuations, inflation came through. Now you have the RFK uncertainty. I think what we've seen in the data thus far, whether it's 5 to 10% of the population on GLP-1s already, it's been really hard to tease out what the impact on volumes have been. You look at certain categories like chocolate candy, volumes are down 4%, salty snacks down 2%. Is that GLP-1 impact or is it elasticity and going to smaller pack sizes? It's really hard to know. But I think you do have situations in the market where the market reacts first, stocks become oversold, cooler heads prevail, and there's opportunities for buying taking the opposite side of that trade. So I think any of these factors should have a longer tail duration as opposed to short-term changes in the market.
John, great to have you here.
Thanks, Josh.
Really interesting.
Appreciate it. Coming up, we are taking a look at the best ways to be positioned within the travel sector in today's Investor Playbook. Stay tuned, more market domination is still to come.
You might be knee deep in the middle of Cyber Monday shopping. Make sure to save some cash for Travel Tuesday. Yes, apparently it's a thing when brands like Delta, Booking.com, and Norwegian Cruise Lines are all expected to offer deals. But which travel tech stock offers the best bang for your buck? With just a few minutes left until the closing bell on Wall Street, we're looking at how to navigate travel tech stocks with the Yahoo Finance Playbook. Joining us now is Michael Bellisario, Senior Research Analyst at Baird. Michael, I got to admit, I didn't really know Travel Tuesday was a thing, but I guess some of these companies are trying to take advantage of the whole theme of shopping online here. I know you just initiated coverage on a couple names here. Who do you think is going to be able to best capitalize on the current sort of hot demand for travel?
Thanks for having me. It's new to me too. I didn't know about it until earlier today. We like both Booking and Expedia. We initiated last week, both of them at outperform, different stories for each. Booking, high quality grower, lots of international exposure. And I think the theme there and the play there is the US dollar is still very strong. And we can all go on vacation to Europe or to Japan. And that's driving a lot of bookings growth. And then Expedia is a bit of a self-help turnaround story. The last year and a half or so, they've really spent a lot of time and effort reworking their systems, their technology back end. There was some disruption there, and it's really about getting through all that disruption now and recapturing lost share. But more broadly, travel trends are positive. People have jobs, people are spending money, and people are getting on airplanes.
With Booking, Michael, that stock, it's had such a nice run already. It's up about 50%, it looks like, this year. What are some risks investors need to keep in mind on that one, in your opinion?
Yeah, that's always tough when the stock runs up and you think about, let me wait for a pullback. Sometimes you might be waiting a long time. I think the broader risk is always a demand shock or some expectation that the consumer is slowing or growth is slowing. I would just turn the clock back 3 months ago. In August, we heard it across the board from investors. You heard it from Starbucks and Lowe's and Home Depot and some of these travel companies that growth was slowing a little bit. And investors always shoot first and ask questions later. And since then, bookings have accelerated, trends have improved, and the stock is way up, along with a lot of the other travel and hotel stocks that we cover. But more broadly, it's the international risk, the cross-border travel, some uncertainty that people will decide not to go on a trip to a particular region. But that's really the biggest risk is it's just the unknown, the uncertainty. Booking windows are still very short. So if something changes, people won't book or they'll go elsewhere. And that would be the biggest impact to these companies' business.
So let's talk about the upside then, because, what we've been seeing on the retail end is that some retailers are doing quite well and some are not doing well. And there is something of an effect of sort of lower income and upper income consumers, but it's not all that, right? It's also sort of specific to if there's something people want to buy, they're going to buy it. If there's somewhere people want to go, they're going to go. Is that kind of what's the underpinning for this travel demand that we're seeing?
Yeah, I always like to say people will travel regardless of the economy and the outlook, as long as they have a job. Their vacation might be 5 days instead of 7 days. And if you live in New York, you might go to Florida instead of Europe. But people have a propensity to travel. And I think in the post-COVID, post-pandemic environment, schedules are more normal now, but still very much longer weekends, shorter work weeks. And as long as people have jobs, have incomes, flights aren't a restriction in terms of both availability and pricing, and people are willing to spend money on travel.
Michael, I see it's just interesting you think about the sort of the arc of travel demand, though. Obviously, you had the pandemic, no one could go anywhere, that ends, and you see a burst of excitement, and now you see that trend kind of, I guess, normalizing. How do you see it sort of playing out over the next few years, Michael?
Business travel is coming back. You continue to see that Tuesday, Wednesdays compression in the United States. It's almost impossible to get a room in New York City now in December. People are traveling for work more. Kids are back in school. So there's just less days to be working in a house in Boise, Idaho, like a lot of people did during the pandemic. And then also, I think people value more highly the time away, and that is going to Europe for 7 days, 10 days, extended periods of time, less about 3 or 4 day long weekends. It's more about shutting down because people are back in the routines. Pretty much everything is back to normal except business travel on Friday and Sunday and certain vacations and trips to and from Asia. But our view is everything's back to normal. I think we just all forgot what normal was because it was 4+ years ago.
Michael, great to have you on the show today. Appreciate your time and those stock picks.
Thanks for having me.
While wrapping up today's Market Domination, don't go anywhere. We've got you covered with all the action following the closing bell. Stay tuned for Market Domination Overtime.
That's the closing bell on Wall Street, and now it is Market Domination Overtime. We're joined by Jared Blickery to get you up to speed on the action from today's session. Let's start with where the major averages closed on the day. The Dow down pretty consistently throughout the day, around the same level, off about 129 points, or about 0.25% here. But we do see some strength in the S&P 500, which looks like it's closing at another record today, up 0.25%, and the Nasdaq up 1%, joining the record club. The Nasdaq had been sort of the laggard in reattaining its record, but it looks like it is there today for both the Nasdaq Composite and I believe the Nasdaq 100, which did even better. And the outperformance of both of those shows that it was large cap tech that was leading the gains here today, and not just large cap tech, but the largest of large cap tech coming back in today's session. We saw some semiconductor makers rally on Friday on the thinking that perhaps some of the export controls that the Biden administration was planning to put on the industry between the U.S. and China would not be as stringent as had been anticipated, and that rally sort of continuing here today. Of course, also we got the news that Intel CEO Pat Gelsinger would be stepping down. So an eventful few days there in the chip industry. Jared's got a closer look now at what else was going on. Hey, Jared.
Hey there, Julie. I thought we'd take a look first at the VIX, which remains pretty depressed here with a 13 handle that is historically low, that is conducive to these risk rallies that we've seen. And you're right, both the Nasdaq 100 and the Nasdaq Composite did manage to eke out records by the close. So here's a 10-year T-note yield. Getting a check on the bond market, we saw, I think we were up 4 or 5 basis points here, dropped off to break even, ending the day up about 2 basis points. Doesn't really make a big difference until we get to 4.5, and that's 30 basis points away, so not real close there. Also checking in on the U.S. dollar index, that was up 0.5% today, and that's closer to its recent highs. Here's a chart of the U.S. dollar index over the year. This is 2024, so you can see there are those highs of the year right there. And let's check in on the sector action. And today was a day of tech outperformance. Let's just, as Julie was saying, this is a mega cap and Mag 7 outperformance day. So tech, consumer discretionary, and communication services, those were the 3 outperformers. Those were the 3 in the green. Everything else in the red. You can see utilities there, the big laggard, down over 2%. Real estate, also interest rate sensitive. That was down 1.5%. And now let's skip over to the Nasdaq 100, where we see all this green, and Meta was leading the charge there. Actually, Tesla leading the charge among the Mag 7, up 3.5%. Meta just behind, and looks like the chip stocks had a decent day as well. I'm going to close here with the Dow so we can kind of compare and contrast. You'll see to the right a lot more red than green, and that's just illustrating that some of the smaller issues today, even in the large cap Dow, just not faring as well. Josh?
Thank you, Jared. Record day on Wall Street for the S&P 500 as investors kick off the final month of the year, and we're waiting to see whether it will be a December to remember. And our next guest is already looking to next year. She set a 2025 target of 6,600 on the S&P 500. Joining us now is Lori Calvasina, RBC Capital Markets Head of U.S. Equity Strategy. Lori, always good to see you. So your 2025 target there, Lori, 6,600. That's your base case. Walk us through the math, Lori. How do you get there?
Sure. So thanks for having me. And look, we take a quantitative approach to the targets. We basically have 5 different sets of models looking at things like the economy, sentiment. We have a valuation and earnings test. We have a cross-asset test that looks at an earnings yield gap. And we also do some political analysis. And so some of the things that we've baked into the base case are, the typical performance when Republicans control everything. That's a gain of about 11%. Our cross-asset model, it's getting close to a point where it won't be favorable for stocks anymore, but right now it's still within a range that points to pretty healthy gains over the next 12 months. That gets us to slightly above 6,700 at the end of next year if we sort of take the pre-Thanksgiving close in the market as the starting point. Our valuation earnings test is the least constructive. It's pointing to a PE at the end of next year on a trailing basis of around 22.7 times, but only gets us to around like 6,200 or so. I could go on and on about all the different models, but basically we run through the math on each of them and we take the median, and that gets us to around 6,600 for next year. And I will say this is the current path we see equities on. As the starting point changes at the end of the year for some of these models, we will update. As we get new information, we will update, but that's the path that we see us on right now. We do think, though, that you could have a 5 to 10% drawdown at some point, but we could still get to that 6,600 at the end of the year.
Lori, it's Julie here. It's good to see you. I thought it was interesting, the point you just made, which you made in your note as well, which is, that you're going to revise, that you're going to, things change throughout the course of the year. And when you talked about that, you also talked about it with regard to economic data. Acknowledging that there were few people who saw the path of the economy, how it ended up this year. Most people were underestimating that. Is that sort of now baked in? In other words, Do you think most of the time people are still going to underestimate, or has there been that sort of correction?
So what we've seen generally post-COVID, and the exception is 2022 when we sort of had the recession near miss, but generally what we've seen is that whether you're looking on sort of a quarterly basis or the annual forecasts, that GDP forecasts have started out too low and are constantly being revised up higher. That's the complete opposite of what we saw in the post-GFC world, kind of post-GFC pre-COVID, where GDP forecasts were constantly overestimated and had to be pulled down. I think that people, frankly, are still stuck in that post-GFC pre-COVID world. You know, I've been around in the business since 2000, but I know, and I feel like a little bit of a dinosaur, but I know a lot of people who are making big decisions these days who came in around 2008, 2009. And so I think there is a risk that sort of your formative years in the industry can cause you to sort of overcorrect for the problem that you encountered early on in your career. I certainly had that problem with tech stocks. You know, at certain points in my career, I came in the middle of the tech bubble implosion. So I think we are still probably stuck in this mentality for a while in which we are underestimating the economy going forward. And I had to make a decision, Julie, like the consensus forecast is 2% for next year. If you look at the sell side, now a lot of those data points are stale from pre-election, but there's a big difference in my work. If you're in a 1 to 2% GDP range, that's, you know, I think you've only been up 40% of the time when that's happened in the stock market. It's a pretty weak environment. And if you look in that sort of 2 to 3% GDP environment, you're up about 70% of the time with plus 10%, you know, I think it's like 11% type annual average returns. And so I had to guess, you know, which way do I think this is going to go? I think given that history recently of underestimating and the fact that GDP forecasts for next year are creeping up very, very, very slowly, I'm making a bet on the 2 to 3% instead of the 1 to 2.
And Laura, you talked about the economic backdrop. Let's talk about the political backdrop as well, because you told your clients, listen, you see, you know, tailwinds, but also possible headwinds for the market in the year ahead. What did you mean by that, Lori?
So this really goes back to a pre-election survey that we did with our analysts, if we're thinking about that, you know, sort of political backdrop. And so we asked our analysts, you know, what's the outlook under different scenarios, Republican sweep, Democratic sweep, yada, 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 you know, and we asked them to sort of, you know, not just tell us, is this good or bad for your industry outlook if this thing happens, but why? We wanted them to tie it to policy. And the policy part of that survey was so fascinating because we had a lot of analysts who came back with kind of weak scores or mixed views. And the thing they told us generally was the tariffs are bad. Things like tax cut and deregulation, if we get them, are very good. And so there were some clear positives and some clear negatives. You know, we saw a lot of people involved in the industrial complex, for example, also had serious concerns about what's happening with IRA spending. A lot of those came from outside of the U.S., but did still filter into the overall outlooks. And so I think that, you know, we've gotten past election uncertainty. There is still a lot of policy uncertainty with some things that are clearly going to be excitable or make market participants excited. And there are some things like tariffs that could potentially be a problem. And the truth of the matter is we just don't know right now exactly how all of that is going to shake out.
We don't, Lori. And I mean, in your note, as you always do, you talk about a more bullish case and a more bearish case. The number we talked about, 600, is your base case. On the bear case side, where you're at 57.75, what is the biggest risk? Is it a fiscal policy risk like that, something out of Washington, or is there something else you're watching from that could trigger that more bear case?
So, you know, I think in my base case, we're assuming that there are going to be good vibes in the new year. We got an earful from companies this year talking about how things were frozen, whether it was businesses or consumers, because of the election uncertainty. So we assume that's going to unfreeze and give us some tailwinds. But maybe we'll be wrong from that. Right. You know, there's certainly been some survey data out there suggesting that there really wasn't all this freezing that companies were talking about. So I think the economic thing is one thing to look at. Also on the economy, are interest rates perhaps starting to pinch in a way we're not seeing in the data yet? I've seen some hints on the corporate side that might be starting to happen. So those are some things we're going to have to watch. I would say, though, generally, regardless of what, you know, might trigger a bear case, valuations are looking pretty frothy. If you look at sort of a median PE on S&P 500 equal weighted, it's getting close to past highs. It's got a little room to run, but not a ton. If you look at sentiment data, AAII net bulls was giving you a warning signal back in October. That feeds into our bear case. And CFTC data, while we don't sort of factor that in specifically to the targeting process, you're hitting new highs on U.S. equity futures positioning. Guess when the last time was we did this? January of 2018, right before we had a pretty tough year in the equity market. So I would say those things make us vulnerable to bad news if it comes. What could some of that bad news be? I do worry a little bit that some of the assumptions about corporate tax cuts that are coming are overly optimistic. I have heard references in some of the Trump speeches that I watched where he was talking about 15% if you're a domestic producer. I hear a lot of people just saying, hey, 15% for everybody. Let's bake that into our earnings forecasts. That doesn't seem quite right to me. So maybe there's some disappointment there. And then I think, again, I think most people are assuming that, they hope tariffs aren't happening. They think they're not modeling them in the same way I'm not in my base case. But I think you can look at the market performance in 2018 when we had the China trade war and we were down more than 6% for the year and 20% peak to trough as an example of what, some policy hiccups could do. Admittedly, we had Fed problems back then, concerns over QT, concerns that the Fed had hiked too much and that was going to tighten us into a recession. So those things, I think, had a bigger impact than the tariffs. But we're also kind of peering into next year, right, where it seems like maybe Fed cut assumptions are a little bit too optimistic. So we've got to watch that Fed messaging as well.
And inflation was also a lot lower back then, to throw that into the mix. Lori,
Yes.
It's great to see you. Thank you so much. Really appreciate your time.
Good to see you.
Well, if big tech had any doubts about what the incoming Trump administration had in store for the sector, the president-elect's pick for FCC chair, Brendan Carr, probably gave them the clues they needed. Joining us now with more, Yahoo Finance's Alexis Keenan. Tell us what we know about him, about Carr, and what that pick could mean.
Yeah, so kind of trying to read the tea leaves of what he's going to do in his policies that he lays out as chair of the FCC. Brendan Carr did post to X pretty immediately after getting his announcement of his appointment. And he called big tech the censorship cartel. And he said that they need to be dismantled was the word he used. He also sent a letter to the CEOs of Meta, of Google, of Apple, of Microsoft as well, accusing the companies of silencing American speech, also accusing them of caving to the Biden administration's pressure to change, amend, block, delist, derank posts that third parties were putting on social media. Also, as for TikTok, so outside of the U.S., saying the Chinese-owned company, the divest or ban policy, the law that Biden had put into place, that is strong. So we could see his views on TikTok.
Like he likes that one.
He likes that one.
Okay.
He likes that one. But much of his vision can also be seen in the right-of-center policy paper known as Project 2025. He says, a big one is to get rid of Section 230 the way it exists right now. And that exists in the Communications Decency Act, which is in the FCC's purview, part of the Communications Act of 1934. It's a long-standing law. But newer Section 230, we all know that it's been protecting social media companies from liability when third parties post content on their sites. It's been really a free pass, allowing them to moderate content, change it, take it down. And so he wants to change that, but he might not be able to do that unilaterally at the FCC, right? The FCC makes rules and it does interpret and enforce the Communications Act, but he probably is going to need Congress. It's been a big debate all the way back, going back many years now, at least 5 years, debating whether the FCC at all can interpret that act. So there's good arguments on both sides, but it probably is going to take a little bit more, especially in light of the Supreme Court's decision this year in the Loper-Bright case. That's where the Supreme Court did away with the Chevron deference. Going to say, well, it's an agency. We're going to defer to an agency's interpretation of a law, and we're going to go with that when there's gray area in a law. So I think that it's going to be a lot more difficult, even if the FCC years ago said, we have the power to do this. It's going to be much harder under this administration and going forward now with that decision on the books.
All right, a lot of moving pieces and personalities. Alexis,
a lot of
thank you.
personalities.
Appreciate
yeah.
it.
Yeah.
Stick around, more market domination over time coming up.
It's Cyber Monday, and a record $13.2 billion is expected to be spent, up 6.1% year over year. That's according to Adobe Analytics. And this follows new milestones for online spending on Black Friday as well. Commerce company Shopify seeing its merchants drive a record-breaking $5 billion in Black Friday sales this year. Here with more insights into merchants and that consumer spending is Shopify President Harley Finkelstein. Harley, thanks for being here. So obviously people are out there shopping in force, or at least sitting on their computers and phones shopping in force here. What are some of the biggest differences that you're seeing between this year and last year, or the last several years, in terms of that uptick in spending?
Yeah, it's a great question. Great to be here, Julie. I mean, I think Black Friday was incredible. As you mentioned, we saw a record-breaking $5 billion in sales. But we saw brands like Brunt Workwear, which are averaging, I think, an order every 6 seconds for the entirety of Black Friday. We saw peak sales per minute globally at about $4.6 million per minute at around noon Eastern time on Friday, which was up from about 4.2 million per minute at our peak last year as well. But two things that are different this year. One is it's just a longer season. We've expanded from being, 4 days or 6 days to really, we saw brands like Gymshark, which is historically a famous online brand, build an offline store in New York City for 3 months. They did a 3-month pop-up for the holidays, and we think it'll continue right till Christmas. But the second thing that you're also seeing is that the way that these brands are selling, they're sort of channel agnostic. Obviously, they're selling online, but they're also selling in physical locations. They're using social media. They're creating subscription clubs or creating membership clubs. It really does feel like this is a sort of a new golden age of retail, and it's being powered by these independent brands.
And Harley, what is the average cart price in the U.S., and how does that compare and contrast to what you were seeing last year?
Yeah, it's actually quite remarkable. The average cart price right now is about $154, which is quite similar to last year. So there's not a lot of changes then. But if you look at the trending products right now, Cozy Earth, Brook Linen, Calpac, Lola Blankets, those are brands that we historically have not seen necessarily at the top of the list. You're also seeing an uptick in subscription boxes. Allure is doing one with a curated beauty box. Obviously, BarkBox and ButcherBox are sort of famous for doing these subscription boxes. So cart size is about the same. But again, there does seem to be this real, there's a lot more energy around these consumers buying directly from the brands that they love. And those brands tend to be powered by Shopify.
It's funny, by the way, that you mentioned Gymshark, because my 15-year-old son put that on his list as something that he wanted. It wasn't a brand that I knew of.
Amazing story.
Yeah. Well, yeah. I'm going to be checking it out. You mentioned that a lot of people are now sort of channel agnostic, but I do wonder what is working better, whether it's certain social channels, where are you seeing a lot of the buying happening, or is it mostly people going directly to the websites for these brands?
It's happening everywhere, but I mean, obviously social selling on social networks is a very new thing. Shopify powers social selling on platforms like Instagram and TikTok. And we actually did a survey, and we found that between the ages of 18 and 24, about 57% of buyers told us they're going to buy on Instagram, but 56% told us they would buy on TikTok. And so I think for some brands, social media is really becoming a favored customer engagement strategy for a particular type. But the other thing that's also really interesting is this idea of what we call default global, where brands that historically only sold in one geography are selling globally. Ilia, for example, Ilia Beauty, recently launched in the UK. They've seen 88% growth in the UK. Laura Geller seeing over 100% growth in international markets. So that's another one. But I think the other thing that's really cool is what we're sort of referring to as community-driven commerce, where brands are really rewarding their most loyal fans. BarkBox, for example, actually created a quiz for their consumers. First, answer a bunch of questions about pets and about your pet, and then you sort of get, then you get access to these incredible discounts. But it feels like it's more than just a transaction. It feels like this immersive, gamified experience, and it's making commerce and retail very exciting again. And in fact, you might be able to pull this up, but we actually track global sales on Shopify, and anyone can see this. It's shopify.com/Black Friday. And right now, as we speak, we're seeing about 2.6 million sales per minute, about 21,000 orders per minute happen on Shopify as we speak. So the amount of, there you go, you pulled it up there. I mean, you are now watching millions of stores powered by Shopify all over the world. And what's really interesting is that every now and then you'll see a little bit of you'll see a firework. That firework is a brand new entrepreneur getting their very first sale. So you're seeing big brands like, the Aloes of the world, Alo Yoga of the world, and Viore doing great on Shopify. But you're also seeing brand new entrepreneurs have their first sale on Shopify as well.
Harley, I want to shift gears here a little bit and talk about how you all are kind of moving up market here, right? You're helping big brands sell online. I'm curious, Harley, kind of the traction you're seeing there, one. And two, as you do that, Harley, obviously you come in competition there with Salesforce, with Adobe. What competitive advantage do you bring here?
Yeah, I mean, you're absolutely right. We are winning in the enterprise quite a bit. I mentioned Alo and Viore, but Skims, On Running, Barnes & Noble, Mattel, these are the brands that have been coming to Shopify over the last year or so. The main thing we're doing is this is a modern retail product. So it's not just online, nor is it just offline. It allows all these brands to create this retail operating system that enables them to sell across every single channel, even channels that didn't exist a couple years ago. We now have a Roblox channel for a particular type of merchant that wants to access the Roblox universe. They can use Shopify to sell right into that as well. So what we're trying to do relative to other enterprise e-commerce companies is create sort of the final migration they'll ever need that allows them to sell across every single channel. And it's easy to use. It's incredibly scalable. I mean, that's Supreme behind me. That's the Supreme skateboard. I mean, companies that do these massive flash sales are selecting Shopify, and they're able to do it at this incredible price with great value. And so in the enterprise in particular, we're winning a lot of the best brands on the planet.
Harley, great to see you. Always appreciate your time and insight. Thank you, sir.
Appreciate you, Josh.
Amazon Web Services is unveiling a series of changes to its data centers to make them more efficient. Yahoo Finance tech editor Dan Halley sat down with the AWS VP of Infrastructure, Prashad Kalyanaraman, about the announcement.
It's very exciting for me to talk about this innovation that we've been working on for some time. There are about a few parts of this innovation, and they're all built in a fairly modular form. And the first one I would say is that we've done a ton of improvements in terms of simplification of our electrical and mechanical design that'll improve the availability for our customers even more. The second part of it is that generative AI requires a meaningful amount of power for these racks and for these chips. And we've been innovating on our power delivery design to these servers as well. Third part is our cooling design. And we've innovated in such a way that we can retrofit our existing data centers for liquid cooling as well as air cooling. And finally, our improvements in mechanical and electrical efficiency to the tune of about 40 to 46% or so has actually improved the amount of capacity we can deliver for our customers in the exact same data center. So all from a simplicity, from a innovation in terms of capabilities we can support for generative AI, as well as our sustainability. We're very excited about this announcement.
So I got to ask, NVIDIA, obviously, with their Blackwell chip coming, is this kind of helping to prepare for that, ensuring that it's able to run? I know you mentioned liquid cooling. That's something that NVIDIA has talked up with Blackwell. Is that kind of a preparation for that? And then can you just give us an understanding of what liquid cooling means for most people?
Sure, absolutely. We've been partnering with NVIDIA for a very long time. And so we've been innovating on the server design as well as our power delivery design and our cooling design for a long time as well. So if you actually step back and look at the generative AI infrastructure that we've built over many years, it all started off with primarily air cooling. So you want to actually use air cooling as much as possible because one, it uses less mechanical energy, less cooling energy, and which means that you have more power available for compute. The latest set of chips from NVIDIA, which are the Blackwell processors, do require liquid cooling. And so we've been innovating in such a way such that we can run liquid cooling infrastructure as in addition to air cooling infrastructure. For instance, if you look at the networking capabilities that we have to build or the storage capabilities that are required, you don't need liquid cooling for that. And so being able to run both the Blackwell chips as well as storage and networking servers in the same facility requires a combination of both liquid cooling as well as air cooling.
And I just want to ask, as far as we're talking about the efficiency, and we've talked a lot about power usage and then the need for improved power plants. Does this kind of help push that back a little bit as far as improving efficiency, improving the capabilities that these data centers have to offer? Does it mean less of an impact on the grid than previously?
Yeah, well, this is the reason why we actually spend a lot of time on improving our electrical and mechanical efficiency. First, our mechanical efficiency with these enhancements improves by 46%, which means you have more power that's actually available for compute. So the data center itself takes the same amount of power, but now we're able to run a lot more compute with the same amount of power.
All right, be sure to tune in to Asking for a Trend tomorrow as I speak with CEO of AWS, Matt Garman. He'll join me live from the company's Reinvest event in Las Vegas, Nevada. Well, time now for what to watch Tuesday, December 3rd. Starting off on the earnings front, we're going to be getting a new batch of earnings tomorrow from Salesforce, Marvell, Okta, and Box. Salesforce announcing results for the third quarter after the closing bell. Analysts focusing on new products from the company, including Agentforce and Data Cloud, and the increased hiring and marketing initiatives around them.
Taking a look at jobs, the monthly JOLTS data, that's the job openings and labor turnover survey, that's coming out in the morning. Economists forecast that number will increase to 7.52 million. This coming after September's number dropped to 7.44 million, which was the lowest level in more than 3.5 years.
And moving closer to the Fed, we're going to be getting some Fed commentary from Fed Governor Adriana Kugler and Chicago Fed President Austin Goolsbee. It's coming after comments earlier today from Fed Governor Christopher Waller. Waller saying he's leaning toward a rate cut in December.
That'll do it for today's Market Domination Overtime. Be sure to come back tomorrow at 3 p.m. Eastern for all of your coverage leading up to and after the closing bell.
But don't go anywhere. On the other side of the break, it's Asking for a Trend. Stay tuned. Hello and welcome to Asking for a Trend. I'm Josh Lipton, and for the next half hour, we're going to be breaking down the trends of today that'll move stocks tomorrow. There is a lot to keep track of, so we're focusing on what you need to know to get ahead of the curve. Here's some of the trends we're going to be diving into. Investors kicking off the final month of the year on a high note. The Nasdaq and the S&P 500 closing at new highs, thanks to gains in Tesla. Intel shares, meanwhile, reversing course after CEO Pat Gelsinger stepped down. We've got a look at the takeaways of the trading day. Plus, the latest tariff threat from President-elect Trump. He's now calling for a 100% tariff on BRICS countries. We're looking at the implications for the economy that's ahead. And the holiday shopping season off to a strong start. In our chart of the day, we're taking a closer look at where people are spending in-store or online. BRICS Pay is a new attempt by a group of 10 nations to get around the dollar. It's also become the latest target for potential tariffs proposed by President-elect Donald Trump. For more, we're bringing in Yahoo Finance Washington correspondent Ben Worschel. Ben.
Hey, Josh. Yeah, so it's another week. It's another kind of outsized tariff threat from President-elect Donald Trump. This time it was Saturday afternoon, and in a post from Trump threatening, as you mentioned, 100% tariffs on BRICS countries. The issue here for Trump is around the dollar and about protecting the dollar. What he wants is a commitment to not undermine the dollar. What this will lead to eventually, very much unclear, but it could kick off some talks. One area that's under focus is this idea that's been floating out there of a BRICS currency. This is sort of like an equivalent of the euro, but for these nations, that would be its own sort of direct rival to the dollar. But what experts caution is that's more of a notion. That's not a real thing yet. It hasn't been formally proposed, and even if it was, it may not work. It's sort of skeptical that it would work. Where it could get interesting, though, is on this BRICS Pay program you mentioned, which is a program which is real. It launched a couple months ago, and it's an attempt to kind of get around the dollar and allow, say, if you're an Indian in India wanting to buy something from Russia, you pay in rupees, and it comes out in rubles on the other end. And this kind of cuts out the dollar completely, which is very hard to do at the moment. So this is the ambition here, is to be kind of a digital wallet that's both old school with bank-to-bank connections, but also new with blockchain technology to create this new thing. And it's being built out as we go. And so that's where it could get interesting in the talks to come. Overall here, though, there's a lot of skepticism about what this latest threat. He made one last week to Mexico and China. This week it's these BRICS countries, what it means. Ian Bremmer of the Eurasia Group called it a tweet, sort of a threat for Trump's own amusement. So you can take that as one level of looking at this. But it gets at a larger issue here of kind of what's the dollar going forward, and can the rest of the world, quote, de-dollarize? And it's interesting, Ben, because for Trump, I mean, this is a long-standing issue for him, right? I mean, he's pounded the table on this for a while, emphasizing, listen, he wants the greenback, he wants the U.S. dollar to remain the world's reserve currency. It's a long-standing issue for him, is it not? Yeah. This has been him kind of going back a long time back to his first term, and he's long been kind of a dollar warrior for sure. I guess the question is, what kind of concession can he get from this threat that allows him to declare a victory? Does limiting BRICS Pay in some way do that? Does he actually have to get some sort of commitment? What does that look like? And can you actually protect the dollar given these sort of larger trends that I think we talk about day in, day out of a kind of Western world and an Eastern world that maybe are diverging a little bit. So it's going to be a theme for his whole term for sure. Ben, thank you, buddy. Appreciate it. Thanks much. Talk to you. Well, the future of international trade grows uncertain amid President-elect Trump's tariffs threats. To diagnose the potential risks ahead for the U.S., we have CFR Maurice Greenberg, Senior Fellow for China Studies. Zoe Liu joins us now to discuss. Zoe, let's start there. President-elect Trump wants this commitment from the so-called BRICS nations, the BRICS countries, Zoe, to use the dollar, threatens a 100% tariff. What do you make of it, Zoe?
In a lot of ways, I think this really gives the President-elect Trump the bargaining power to begin with. But in reality, I think, the idea of a BRIC coin or a BRIC currency is not there yet. And I doubt the BRIC countries would ever get there. But then on the other hand, if we take a look at a specific within BRICS countries trade, moving beyond US dollar and using national currencies has been a trend. Starting from 2014, President Putin already talked about the idea of using national currencies. And fast forward, starting from 2018, Chinese also take more initiative to expand the renminbi-based international transaction system. So from that point of view, despite there is no such a BRICS currency or BRICS coin, the idea of moving beyond the US dollar and using local currency for trade is a trend to start with.
So bottom line, Zoe, I've heard commentary that just would make the argument the dollar just has the edge in the foreseeable future, just given the infrastructure that supports the greenback. Is that your view?
I would say so. So far, there is no other currency that can challenge the dollar's dominant currency position, and the renminbi does not really have the corresponding asset, such as the equivalent of the U.S. Treasury in terms of international transaction or international market demand. But that being said, the overuse of sanctions and the broader moving beyond dollar in terms of a conversation, in terms of discussion, that trend has started, and the financial plumbing has already started. So from that point of view, the infrastructure for de-dollarization is there. But does that mean de-dollarization is the same as dethroning the US dollar? No, it's not the same.
So I want to broaden out the discussion, talk a little bit more about U.S.-China relations, which you know so well. I'm curious, Zoe, how you think Trump's approach is going to compare and contrast to the Biden-Harris approach when it comes to China.
And Josh, I think you made a really good point in terms of comparing and contrast. And I would argue that if the Biden's China policy actually represent a lot of continuation from President Trump's first term, the technology ban, or for that matter, cutting Huawei out and making sure that China does not have access to advanced technologies that can potentially empower the Chinese PLA. So a lot of these measures are more or less the same. But I think what may make the second Trump term different compared with before is that the level of uncertainty would be higher. And over the past 4 years, the Chinese economy, in terms of building up defense against U.S. sanctions, has also strengthened.
I'm interested, Zoe. We know the tariffs Trump has threatened when it comes to China. As you know, some people say, hey, that's a negotiating tactic, it's a negotiating strategy. I'm curious, what do you think Xi Jinping could counter with that might make Trump feel like, okay, you know what, I got a good deal, I can back off?
I think the market ought to, or for that matter, Chinese policymakers would for sure take Trump's tariff threat very seriously, but they would not necessarily take his words literally, meaning they know tariff is coming, but is it going to be 60%, 70%, or even lower? That's uncertain, right? That's the sort of like a bargaining power coming into. And from China's point of view, I think there are probably 3 broader categories of strategies or response. The first one is, tick for tack. And if China were to impose this tick for tack tariff policies, that basically means food sector, agriculture, and chemical industries, they are more at exposure in terms of being levied on tariff by the Chinese. And then the second policy would also be trying to expand and diversify China's trading partner, reducing the dependence on U.S. market. And the third part would be China would continue with its current trend, which is to make a broader argument or declare low tariff or even zero tariff for a lot of developing countries as a way to show that China is upholding the so-called international trade high moral ground, and China is trying to safeguard international trade.
Zoe, great to have you on the show today. Thank you so much for your insight and analysis. Appreciate it.
Thank you for having me.
The S&P 500 Nasdaq closing at record highs to kick off December. Yahoo Finance's Jared Blickery joins us now with the trading day takeaways. Jared.
Nice to kick off December with some green, and that's kind of the focus here, although I want to focus on what's happened since the election. And we've seen some post-election sizzle as well as some fizzles, so let's take a look at what has been hot first. And we're going to take a look at the sector action since November 5th, right before the election. Only healthcare in the red right here. You're going to see some underperformers. Tech is on the second line. That's XLK all the way down there. What's number one? That's XLY. That's consumer discretionary. Those are those retail stocks. And number two, you got financials. Then you get the mega cap sector that houses Alphabet and Meta. That's communication services and industrials, energies. So that's a kind of a broad swath of leadership that you have right there. Speaking of leadership, let's go to our leaders where we have Bitcoin. Since the election, that's up over 30%. ARK, remember ARK, that's up 23%. Regional banks, 13%. Gambling, software, Magnificent Seven. So another mix. It's not just the big guys, it's not just the small guys. We even got IWM in there, up 7.8%, Josh.
It wouldn't be a Jared Lickery story if I didn't ask you about the greenback. The dollar.
The dollar?
What's going on?
Oh, stay tuned here because the dollar wrecking ball, that's kind of the theme. I explored this with Raoul Pal on a Stocks in Translation podcast, and we were talking about why the US dollar, when it's rising, is not necessarily good for risk markets. Let's take a listen.
So when the dollar is too strong, we talk about the dollar wrecking ball.
Yes.
Because what happens is, in a world that borrows a lot of dollars, the dollar that's expensive means it's difficult to get enough dollars in the system to pay off global debt. So we've seen, for example, China's real estate sector. It's mainly a dollar borrower. When the dollar's expensive and they earn in yuan, it's difficult to pay the debts. So that tends to what happens when the dollar is high.
That is some impressive neckwear right there that gentleman was wearing. I'm showing you a chart of the US dollar index. This is year to date, and I just want to show you, the election was somewhere in here. So the dollar was already rising, then it shot up even more. And well, the administration policies of tariffs and also curbing immigration, those could have additional pressure shooting the US dollar even higher. If it goes above these current levels, I'm going to show you a longer term chart, show you where it could go. So we've been kind of locked in this band for the last few years, and way up here is a pandemic burst. I think we saw that in 2022 when the Fed was aggressively hiking rates. So higher rates, well, that also increases the dollar, and now we have the prospect of the US not lowering as fast as other countries. So all of this put together, you'd love to see the dollar roll over here to protect and support risk assets, but if it goes higher here, it's going to be the opposite.
All right, that was the dollar.
Yes.
What about the bond market? What are we seeing there?
Good segue here, because guess what? Rates just re-inverted. So remember the yield curve inversion that we were talking about years ago. There are different ways to measure yield curve, and I'm doing it with the 10-year and the 2-year. So if you consider like all the way down here, you might have a 1 month all the way to a 30-year. Well, I'm doing the 10 and the 2. And if you subtract the 2 from the 10, well, guess what? We were inverted. That's when the 2-year was above the 10 for years. And that had to do with the Fed raising rates. And we just emerged from that situation only a few months ago, but now we are back in that inversion territory. And one thing that garnered a lot of discussion in here was the recession, because when the yield curve inverts, historically you get a recession. Only time in history this did not happen. So does it mean that we're not going to get a recession this time? It's hard to say, but I think it is notable that the yield curve is still in play here, and some of these dynamics years after the Fed was aggressively hiking.
All right, thank you, Jared. Appreciate it. Stick around, more Ask for a Trend right on the other side. Well, the November jobs report to provide updates on job growth and unemployment in the U.S. But as the labor market continues to slow, our next guest highlights a cautious narrative in the job market. ZipRecruiter chief economist Julia Pollack joins us to discuss. Julia, always good to see you. I want to start with how job seekers are feeling right now, Julia, because you have a unique line of insight there. What are you seeing?
Well, we have actually seen quite a rebound, both in job seeker sentiment and in the sentiment among newly hired workers in just the last month. So there is definitely cautious optimism in the air.
And what do you chalk that up to, Julia?
So at the beginning of this year, many observers still expected a recession with interest rates so high. And we have narrowly we've avoided that recession. The labor market has not slowed nearly as much as anticipated. And now we're seeing stock market gains that are very encouraging and large, and we're also seeing them broaden out. And so there is an anticipation among employers and among job seekers that we might see those gains in the labor market too, and not just in a couple of places, but that the whole labor market might get a lift.
And demand for workers, Julia, right now, where are you seeing that concentrated? Are there certain areas where it's strong and also relatively weak?
I think the most important labor market trend at the moment is how narrowly distributed the job gains are. Those top line figures sort of betray underlying weakness in more than half of the labor market. So more than 100% of the job gains in the last quarter came from just 4 sectors that are less than half of the workers in America. The other half of the labor market was flat or negative. And that is why there are still so many job seekers who are struggling, especially in among white-collar new grads and people looking for their entry-level jobs.
And that trend you're talking about, Julia, is that a switch? I mean, was it different, say, 6 months ago, 12 months ago?
Well, so typically when interest rates are high, you see manufacturing and construction and industries like that shed workers. And often the white-collar world is relatively insulated, but that's not the case now. It's also, I think, more jarring for workers in those sectors because job growth was so high in 2021 and early 2022 in exactly those parts of the market.
What are you seeing in terms of wage growth, Julia?
So wage growth, we're seeing something interesting. At the beginning of last year, many employers felt a sense of sort of being overburdened by the wage increases that they had made earlier in the pandemic. And almost half told us that they were expecting to reset wages lower for some new hires. Now, in our most recent employer survey, I'm going to give you a little look into that. It's not yet published, but the majority, 3/4 of employers say that they expect to raise pay substantially in the coming year. A quarter expects significant, sort of outsized, more than 5% increases. And many of those increases are expected in precisely those white-collar sectors that have been stagnating over the past year or two.
Interesting. Julia, final question. Friday, big jobs report, of course. What are you expecting to see?
Well, many people expect to see a big rebound after that dismal October report. But remember, whatever number we get, I'm expecting about 150,000. About 40,000 of those will be not new jobs created, but people coming back to work after strikes. Some portion may also be people showing up on payrolls again after the storms. The broader trend that we've seen over the past few months is a slowing and narrowing of job growth. And even in last month's reports, it was actually the numbers for the previous months that really raised concern, the 112,000 downward revision and the narrowing of job gains.
Julia, always great to have you on the show. Thank you so much for coming on.
Thank you, Josh.
Coming up in this week's episode of Money Glow Up, host Tiffany Aliche talks with career expert and executive coach Laura Gassner-Otting to unpack the financial pros and cons of trade school and college. Be sure to scan the QR code below to stay up to date with all the latest episodes, and be sure to tune in to Money Glow Up every Thursday at noon. Here's a look at this week's episode.
We also see venture capital funds that are, they're investing left and right in trade schools because they know how much they're going to grow. I mean, the 200,000 jobs I mentioned earlier, that's just in the construction industry. So imagine how it's going to grow when we think about the solar panels and the clean tech and electric cars and all the rest of the new technology that we haven't even imagined yet.
Well, for our chart of the day, we're going to be breaking down Black Friday traffic, one of the busiest shopping days of the year. And Yahoo Finance's Julie Hyman joins me now with a closer look. Julie.
Yeah, one of the busiest shopping days of the year, and people were actually going into stores, according to Placer AI, which tracks that data. But they weren't necessarily going into stores in the same numbers that they were last year, and they weren't necessarily going into the same kinds of stores. So what Placer AI did was track the numbers here, both compared to 2019, those are the green lines you see here, and to last year, those are the white lines. And so you saw in particular a couple areas of weakness, both year over year and since pre-pandemic, and that's in electronics stores, which saw a pretty steep drop compared to 2019 here of about 41% drop in foot traffic, and then about a 16.5% drop year over year, and then department stores seeing a big pullback as well to, compared to 2019 and also compared to last year. But then a couple of areas where you saw some increases here. Beauty and self-care up 42.8% since pre-pandemic, but down year over year. So a longer-term uptrend, short-term downtrend. Same goes for the discount stores, which saw a 12% gain since pre-pandemic, but have been down about 3% year over year. Put all this together, what does it all mean? Well, there was some interesting commentary from Ethan Chernovsky, who's the Senior Vice President of Marketing over at Placer AI, and he said the role of in-person shopping has changed here. In some cases, people are going to the stores, but they're not necessarily going to the register at the stores. They're still buying things online, so using the stores to kind of check stuff out. He also points out that because of that, the bigger ecosystem, the coffee shops, the movie theaters, that part of the equation is also important on Black Friday itself. And then we can't talk about Black Friday without also talking about some of the preliminary numbers for today, Cyber Monday here. Adobe's current forecast for Cyber Monday spending, $13.2 billion, which is up 6.1% year over year. Salesforce, meantime, says it's looking for $51 billion. Its numbers are global for today's sales. $13.5 billion in the U.S., so about even with what we're hearing from Adobe, Josh.
All right, thank you, Julie. And that is a wrap on today's Asking for a Trend. Have a great night.